Greetings, members, one and all of the Salivation Nation. The impact of supply on gold and silver. Let's explore. We're going to be taking a look at an article here from CME Group through Yahoo Finance. A fascinating and pretty in-depth article on gold and silver supply side impact on the price. This is interesting to read, especially with what's been going on for the past year with the pandemic and how supply has impacted and has driven price to some degree here. Gold and silver analysis tends to typically focus on demand drivers such as monetary and fiscal policy, as well as their correlation with the US dollar, the dollar index. For example, in the past 12 months, it has been widely assumed that balance sheet expansion by the Federal Reserve and other central banks probably contributed to the rise in gold and silver prices, as we can see here with quantitative easing contributing to the rise in prices of gold and silver over the past year here. And we can see the different colors: silver, the Fed balance sheet, and NASDAQ, and gold, which has risen up over the past year. It's kind of separated itself to a degree from those other factors here. While demand drivers are undeniably important, one should not overlook supply as a driver of precious metal prices. Gold and silver mining production has been on the decline since 2016. In 2020, the pandemic led to a number of mine closures that reduced output of gold and silver ore. Given the historical relationship between mining output and prices of precious metals, the recent declining of mining production, which has been especially sharp for silver, might have contributed to the rise in their prices. But you would think it would have a bigger impact, considering that the silver prices have not been able to breach above $30 an ounce. Gold and silver mining supply has varied over time. Mining supply for both metals stagnated or fell during the 1970s, a period of soaring prices. Gold mining supply more than doubled between 1980 and 1998, a period when prices fell sharply for both metals. Silver mining supply rose during this period, but not to the same extent. So during this 18-year period, gold prices fell from $835 an ounce to as low as $280. In fact, I remember a specific time when we saw silver or gold go down below $260 an ounce, but that was, I think, in the early 2000s. Silver prices suffered an even larger percentage decline, falling from $50 an ounce to as low as $4 an ounce. So here we can see the gold mining production worldwide in this chart. And I think this is quite a fascinating look at the production in all these nations around the world and where we are at here, and seeing how much gold has been produced since 2009 and 10. It's been a lot has been produced here and starting to taper off a bit here. Are people attributing that to peak global mining supply? I don't know. Silver mining supply has been in a steep decline since 2016. But if you look here, even since 2011, it's still far above those periods. But there is growing demand. But so this steep decline that we've been seeing is, especially since 2015 or 16 or so, just the very next year has fallen pretty dramatically, even though we're seeing demand for it increase in the industrial sector. And of course, with the 2020 and 21, we're seeing a great increase in the investment side. So gold mining supply began falling in 1998 and didn't hit bottom until 2009. Between 1999 and 2011, gold prices soared, rising 650%. In contrast, silver mining production rose from 1998 to 2009, increasing from 500 million troy ounces to nearly 700 million per year. Despite rising mining output, silver prices rose even more than gold prices, increasing by 930% from 1999 to 2011. Mining supply of gold rose in 2009, fell slightly in 2010 and in 11, and then climbed by over 20% between 2011 and 2016. Silver mining production soared during this period, and prices of both metals fell sharply, with silver falling by as much as 72% and gold by up to 45% from their 2011 highs. Since 2016, gold and silver mining supply has fallen, with silver output dropping sharply. Gold prices began rising in early 2016. Silver prices didn't hit bottom until early 2020 when they tumbled in the early stages of the pandemic, but subsequently soared by 150% between March and late July, when gold prices rose by a relatively meager 40%. And keep in mind the 2011 highs and the 1980 highs for both metals were just for a very brief period of time. They were anomalies. In a sense, really, these should be averaged out in terms of their peaks, and to see a real true measure of performance here of the prices. Economists are unable to conduct controlled experiments, and thus it is difficult to disentangle the influence of supply on precious metal prices from that of macroeconomic conditions. I imagine it would be very difficult to do. Did falling supply in the 70s cause a rally in gold and silver prices? Given the high rate of consumer price inflation in the aftermath of the collapse of the Bretton Woods fixed exchange rate regime, it's difficult to argue that mining supply was the main factor driving prices higher, especially given that prices for energy, industrial metals, and agricultural products also soared there in the 70s. And I think also there was a time when the price of gold was fixed by the government. Likewise, rising mining supply in the 80s and 90s coincided with tight monetary policy and high real interest rates. Falling gold output between 1998 and 2009 took place alongside the tech wreck recession and the global financial crisis, which saw interest rates slashed to zero and the beginnings of quantitative easing. The 2010s, however, come close to resembling a controlled experiment. From 2010 to 2016, mining output rose for both metals while monetary policy held steady, with rates stuck at zero in the US, Europe, and Japan. The Fed did curtail QE, but didn't really begin to move rates higher until late 2016. Now in 2017 and 18, the Fed raised rates and began shrinking its balance sheet. Normally this might have been bearish for gold prices, yet gold drifted higher during this period. This suggests that the positive price impact of reduced mining supply may have overwhelmed the negative impact of tighter U.S. monetary policy, which had 8 rate hikes and balance sheet shrinkage. In 2019, the Fed began easing again, and all central banks subsequently eased monetary policy during the pandemic, to which gold and silver prices responded by heading higher. In fact, you may remember in between September and December of 2019, the Fed did what's known as repurchase agreements or repos to these central banks to stave off these high interest rates for these day loans to each other. And they injected an amount of liquidity there up to the tune of $700 billion. You may remember me reporting on that. So silver and gold relate to one another. Even though they're categorized as precious metals, both metals usually correlate highly in their day-to-day price swings. There are vast differences in terms of both price and end use, though, and you've heard me talk about that on this channel before. And we can see that they are highly correlated despite an unstable gold to silver ratio. Boy, it really is unstable for sure. And here we can see that. For starters, gold is much more expensive than silver, no brainer there. Since 1985, 1 ounce of gold was on average worth about 70 ounces of silver, and with the gold-silver ratio ranging from 30 to the low to over 120 at the high end. We saw that this past year in March. March of 2020. What this means is that although silver mining output measured in ounces is about 7 to 8 times greater than gold mining output, when measured in dollars, gold mining output is usually about 9 to 10 times as valuable as silver mining output. So there's that range there between 7 to 8 times, and then between 9 to 10 times, depending on how it's measured. This makes gold the dominant member of the gold to silver nexus. Moreover, it helps explain why silver prices rose from 1999 to 2009 as gold mining output fell, and even as silver mining output continued to rise, especially when looking at how the two metals are connected through their end use. So the gold to silver ratio has experienced wild swings in the past decade, and we see that here with this chart showing the gold to silver ratio through that period of time. And as you can see, during the highs, typically silver does outperform and narrows a ratio to, well, in this case, it went down to almost 15 to 1, and here it was about 32 to 1 at that particular time. Of the two metals, gold is used more in jewelry than silver. Of the 95 million ounces of gold mined in 2020, only about 14 million ounces were used in electronics or other industrial applications. And that's fascinating to hear. About 1 million ounces were used in dentistry. The remaining 80 million ounces were made into jewelry or stored as gold bars in vaults. And that is something to take into account too, because one can make an argument from both sides that since gold is treasured and silver is utilized, that means that silver is undervalued by some people's estimations. To me, I think the inverse. I think because gold is stored and treasured is why it is the more stable of the two metals. In contrast, only about 40% of silver is used to make jewelry. The rest is used in electronics, batteries, photography, solar panels, and other uses. Here we can see gold is primarily used for jewelry and investment, gold fabrication demand, jewelry emerging markets, jewelry developed markets. Look at that. Massive amounts of here utilized for jewelry, electronics, dental, and other industrial. Silver is also used as a jewelry, but has wider uses than gold. Much more diversity in silver. Solar panels, electronics and batteries, jewelry and silverware, photography, and other uses. Economically, gold and silver are connected through the jewelry and investment markets because gold is more expensive, and in aggregate, the value of gold production dwarfs that of silver production. Gold acts somewhat like a planet and silver like a moon. Together they have a common center of gravity, but gold is the dominant member of the system. And I think that's why it's more stable in terms of its price gyrations or movements one way or the other. When gold prices rise significantly, as they did between 1999 and 2011, that puts gold jewelry out of reach for many consumers. However, even if silver prices rise by, say, 9 or 10 times, silver remains an affordable alternative for many customers at roughly 1/70th the price of gold, and also understanding that there are very high premiums for silver jewelry out there, which means there's a lot more cushion for producers to profit from silver jewelry than gold. As such, perhaps it is not surprising that jewelry demand for silver shows relatively little response to changes in silver prices in contrast to the extreme sensitivity of jewelry demand to changes in gold prices. And I think that is fascinating a measure here, the correlation here between the two. Besides the differing sensitivities of gold and silver jewelry demand to changes in their prices, another interesting feature is secondary supply. Secondary supply, which is recycled gold and silver, does not appear to be a driver in price. The market already knows that these supplies of gold and silver exist, and they appear to have been taken into account when determining their price. Rising precious metal prices incentivize more recycling of existing supplies. However, the recycling process does not appear to put downward pressure on prices, although that could have an impact if silver starts to be recycled at a closer scale to gold. A regression analysis allows us to see more clearly how changes in mining output from one year to the next influence gold and silver prices. Measured over a 45-year period from the 1970s until now, it appears the changes in mining output of one metal influence the prices of both metals. Interesting. On average, a 1% increase in gold mining output sent gold prices 2.2% lower and silver prices 3.1% lower. A 1% rise in the silver mining output on average sent gold prices 1.8% lower and silver prices 1.7% lower. All but the last of the T-stats passed on the 95% confidence interval test for significance. And then we can see both metals show a negative sensitivity to their own and others' change in mining supply and the sensitivity there for both these metals. Very interesting. So the bottom line is mining output is a significant driver of changes in gold and silver prices. It also makes you wonder if some of these mines may be holding back some of that supply so they can help maybe control their profits potentially. Gold mining output appears to have a major influence in both gold and silver prices. Silver mining output appears to have a somewhat weaker influence on gold and silver prices. When precious metals rise, prices rise, jewelry buyers get priced out of gold but can often still afford silver. Gold and silver are economically connected via the jewelry and investment markets, and higher economic value makes gold the dominant member of the gold-silver system. And secondary supply production responds to price rather than drives it. So I think this is a pretty good and interesting analysis done here on this particular view of supply side with gold and silver. Let me know your thoughts in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.